What if there were a way to invest that didn't rely on luck, hot tips, or guessing the market? A method so timeless that Warren Buffett calls it the best book on investing ever written? Today we explore Benjamin Graham's The Intelligent Investor, a guide that has helped generations of investors make smarter decisions, avoid costly mistakes, and think clearly in the chaos of the market. In the next section, we'll uncover the first secret every intelligent investor must understand: the difference between true investment and speculation. Investment versus speculation. Imagine walking into a bustling marketplace filled with both calm, careful buyers and frantic people chasing rumors, hoping to make a quick profit. Benjamin Graham tells us the financial markets are no different, and the very first lesson for any investor is to understand the critical distinction between investment and speculation. Because while investment is deliberate, grounded in careful analysis, focused on the safety of principle, and aimed at achieving an adequate return, speculation is chasing outcomes, guessing prices, and gambling on luck, which often leads to emotional decisions, panic selling, and devastating losses. A true investor asks questions that matter. What is this asset really worth? Am I buying it because of its fundamentals or because of market hype? Am I prepared to hold it for years? In contrast, speculators focus on short-term gains, price movements, and the fear of missing out, chasing excitement rather than value. Graham emphasizes that the intelligent investor prioritizes long-term thinking, patience, and protection of capital, knowing that the foundation of wealth is built on discipline and rational decision-making rather than chance. For example, buying a trendy stock with weak earnings and high debt is speculation, whereas purchasing a solid, well-managed company with steady profits and dividends is intelligent investing, because it balances safety with adequate return. History provides countless illustrations. During the 1929 market crash, speculators who bought overpriced stocks on hype lost everything, while disciplined investors who understood intrinsic value preserved their capital and seized opportunities to acquire bargains at low prices, demonstrating that emotional detachment and a focus on fundamentals are far more powerful than chasing market trends. Graham urges every investor to develop a clear plan, stick to it, and resist the temptations of fear and greed, understanding that investment is not about predicting prices or timing the market, but about evaluating value, controlling risk, and acting rationally. He writes, "An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative." By internalizing this mindset, investors build the foundation for long-term wealth, learning to differentiate excitement from opportunity, speculation from intelligent planning, and fleeting trends from lasting value. Before investing a single dollar, one must honestly ask, am I acting on careful analysis or impulse? Am I prioritizing long-term growth or short-term thrills? Am I protecting my principal while seeking adequate returns? Answering these questions honestly aligns the mind with the principles of intelligent investing, because as Graham reminds us, the journey to financial success begins not with timing the market, but with mastering your own mind, maintaining discipline, and committing to decisions grounded in value, patience, and careful judgment, setting the stage for every subsequent lesson in wealth creation. The Investor in Market Fluctuations. Benjamin Graham introduces every intelligent investor to the unpredictable nature of the stock market and the importance of understanding market fluctuations, not fearing them, because the market is like a moody partner he calls Mr. Market, who shows up every day offering prices that swing wildly between euphoria and despair, sometimes presenting incredible bargains, other times steep overvaluations. And it is the investor's responsibility to treat Mr. Market not as a guide, but as an opportunity, knowing that his emotional swings are irrelevant to the true value of a business. The intelligent investor, unlike the speculator, does not get swept away by panic or excitement, does not buy because everyone else is buying, and does not sell in fear when prices drop. Because fluctuations are the very mechanism that creates opportunity for those prepared to act rationally, calmly analyzing each offer in terms of intrinsic value and long-term potential, while understanding that short-term market movements are largely meaningless. Graham emphasizes that the key to intelligent investing is psychological discipline, the ability to resist the temptation to follow the herd, to ignore headlines, rumors, and the emotions of the crowd, and instead focus on what truly matters: the fundamentals of the companies being purchased, the margin of safety inherent in the investment, and the alignment of each decision with a definite plan and purpose. He explains that the market will often appear irrational, offering securities at prices far below or far above their actual worth. And it is precisely in these moments of volatility that the intelligent investor can profit by buying undervalued assets or selling overvalued ones, but only if they are emotionally prepared, patient, and grounded in analysis rather than greed or fear. Because acting impulsively during market swings is a fast track to losses, while disciplined behavior turns volatility into opportunity, and over time, this disciplined approach compounds into wealth. Graham's Mr. Market metaphor also serves as a mirror for the investor's own emotions, reminding us that the greatest market fluctuations are often internal. The impulses to act hastily, to chase quick gains, or to surrender in panic. And that mastery over these inner swings is as crucial as understanding stock prices, dividends, and earnings. By keeping a long-term perspective, the investor learns that the market's moods are temporary, that patience is rewarded, and that value always reasserts itself, creating a framework for intelligent decisions that exploit volatility rather than succumb to it. And by internalizing this principle, one not only avoids the traps of speculation, but also gains confidence, clarity, and consistency, turning the market's unpredictability into a strategic advantage, ultimately demonstrating that success in investing is as much about controlling one's mind as it is about understanding financial statements, and that the fluctuations of Mr. Market, instead of being feared, can be welcomed as a source of opportunity and insight, reinforcing the timeless lesson that disciplined, rational behavior in the face of uncertainty is the hallmark of the intelligent investor. The defensive investor Benjamin Graham introduces the concept of the defensive investor, the person who seeks steady, long-term growth while minimizing risk, someone who wants to participate in the stock market without constantly worrying about sudden crashes, losses, or speculative fads. And the core idea is that success does not require taking unnecessary risks, but instead relies on discipline, patience, and adherence to proven principles. The defensive investor focuses on building a portfolio that balances safety and reasonable returns, emphasizing diversification between high-quality bonds and carefully selected stocks, avoiding the temptation to chase high-yield, high-risk investments, because Graham repeatedly stresses that protecting principal is just as important, if not more so, than seeking large profits. This investor does not need to be a market genius or a financial analyst, but must develop habits of consistency, such as periodically reviewing the portfolio, rebalancing to maintain the chosen allocation, and resisting emotional reactions to market volatility, understanding that stock prices fluctuate daily while intrinsic value changes slowly over time, and that by holding quality securities with solid fundamentals, one can sleep peacefully even in turbulent markets. Graham recommends that defensive investors adopt a conservative approach to stock selection, choosing companies with long histories of stable earnings, strong financial positions, and consistent dividend payments, while allocating a portion of their portfolio to bonds to provide a cushion against market downturns, emphasizing that the goal is not to maximize short-term gains, but to achieve steady growth, protect capital, and reduce stress, because the defensive investor's success is measured not by flashy returns, but by enduring wealth accumulation over decades. He also warns against frequent trading, market timing, and speculation, pointing out that most mistakes come from emotional decisions, reacting to daily market noise, or chasing trends, whereas a disciplined, rule-based approach ensures rational decision-making and resilience against unforeseen crises. Graham encourages the defensive investor to cultivate a mindset of patience, restraint, and analytical thinking, asking simple but critical questions before any investment. Is this company financially sound? Does it have a consistent track record? Is the price reasonable relative to intrinsic value? Am I maintaining diversification to protect against unforeseen events? By committing to this approach, the defensive investor builds a portfolio that weathers storms, avoids catastrophic losses, and grows steadily. And over time, these habits compound into financial security, proving that intelligent investing is less about clever tricks or short-term speculation, and more about a calm, methodical, long-term strategy, emphasizing prudence over greed, analysis over intuition, and discipline over emotion, ultimately teaching us that the path of the defensive investor, while perhaps less glamorous than high-stakes speculation, leads to a stable and successful investment journey that withstands the inevitable ups and downs of the market. The enterprising investor Benjamin Graham contrasts the defensive investor with the enterprising investor, the individual who is willing to put in extra effort, research, and analysis to achieve higher returns, someone who approaches the market with ambition, curiosity, and discipline, yet still relies on intelligence rather than luck or speculation, understanding that higher rewards come with more work but not recklessness. The enterprising investor studies financial statements, evaluates earnings, examines dividend history, and looks for companies whose stock prices fall below intrinsic value. Recognizing opportunities where the market has undervalued quality businesses, yet always adhering to the principle of a margin of safety, which protects capital against errors in judgment or unforeseen market shifts. Unlike the defensive investor, the enterprising investor is willing to spend hours reading reports, comparing industries, and tracking long-term trends, knowing that patience, persistence, and knowledge are the real differentiators between average returns and exceptional outcomes. And Graham emphasizes that this approach is not about chasing hot stocks or trying to time the market, but about identifying mispriced opportunities that disciplined research uncovers. Examples abound in the book. Investors who bought solid companies during temporary price drops, whose fundamentals were intact, ultimately reaped substantial rewards, while the impatient speculators who followed hype suffered losses, highlighting that diligence, analysis, and rational decision-making trump intuition and emotion. Graham also warns enterprising investors about common pitfalls, such as overtrading, falling in love with a stock, or ignoring macroeconomic risks, stressing that the extra effort must be matched with discipline and skepticism, always questioning assumptions and verifying facts before committing funds. And he encourages diversification, even for enterprising strategies, so that a single mistake or unforeseen event does not jeopardize the entire portfolio. The mindset of the enterprising investor combines curiosity with caution, ambition with prudence, and active engagement with adherence to timeless investment principles, teaching that successful wealth creation is a combination of intelligence, effort, and emotional control, where research and preparation enable one to exploit market inefficiencies while remaining protected from catastrophic mistakes, ultimately proving that enterprising investing is not about luck or clever timing, but about structured, informed, and patient action, turning the market's fluctuations into a playground of opportunity and demonstrating that consistent effort guided by knowledge and discipline produces compounding advantages over time, reinforcing Graham's overarching lesson that intelligent investing is a mindset, not a formula, and that those who approach the market with preparation, courage, and careful judgment will be rewarded for their diligence while avoiding the traps that ensnare the speculative masses. Portfolio policy for the individual. Benjamin Graham emphasizes that every intelligent investor, whether defensive or enterprising, must have a clear portfolio policy, a structured plan for how to allocate assets, manage risk, and balance growth with safety, because the way you divide your investments ultimately determines both the security of your principal and the potential for long-term returns. He advises that the first step is understanding your own temperament, financial goals, and risk tolerance, because a portfolio designed for someone who sleeps well during market volatility will look very different from one intended for a more aggressive investor. Yet the principles remain the same. Maintain a sensible balance between stocks and bonds, diversify across industries and asset classes, and never commit more than you can afford to lose. For the defensive investor, Graham recommends allocating roughly half the portfolio to high-quality bonds and half to leading stocks, adjusting as necessary between 25 and 75% based on market conditions, while emphasizing that the focus should always be on safety of principal and reasonable returns, not chasing extraordinary profits. The enterprising investor can tilt the allocation toward equities or undervalued opportunities, but must remain disciplined, maintaining diversification, and ensuring that every investment has a margin of safety. Graham also stresses the importance of rebalancing, periodically reviewing the portfolio to ensure that allocations remain in line with your goals and risk tolerance, which prevents the gradual drift toward excessive risk when stocks outperform bonds or vice versa, and avoids the common psychological trap of being overconfident during bull markets or unduly fearful during downturns. He illustrates how disciplined allocation protects against catastrophic loss while allowing investors to benefit from long-term growth, reminding us that investment success is not about predicting the next market trend, but about staying committed to a plan and adjusting rationally to changes, using logic rather than emotion. Graham emphasizes that rules and policies are more than guidelines. They are the framework for decision-making that shields investors from panic, impulsive trades, and speculative mistakes, reinforcing the value of prudence over greed, consistency over chance, and preparation over intuition. He also notes that individual circumstances, such as income needs, age, and family obligations, should shape the portfolio, and that a flexible, rule-based approach allows investors to navigate unexpected events, market volatility, or personal changes without abandoning their core principles, demonstrating that a thoughtful portfolio policy is not just a static plan, but a living, adaptable framework. Ultimately, Graham's message is that intelligent investing requires a balance between growth and safety, action and restraint, ambition and discipline, and that by adhering to a well-defined portfolio policy, investors can navigate the complexities of the market, protect their wealth, and steadily build long-term financial security, showing that success in investing is not a matter of luck or timing, but of planning, consistency, and rational decision-making over decades, which is the true hallmark of the intelligent investor. Security analysis and stock selection. Benjamin Graham dives deep into the art and science of security analysis and stock selection, revealing that intelligent investing is not about luck or speculation, but about careful evaluation of a company's fundamentals, understanding its financial health, and determining its intrinsic value before committing any capital, because the market often prices stocks irrationally, creating opportunities for those who can separate facts from hype and logic from emotion. Graham teaches that every investor, whether defensive or enterprising, must learn to read financial statements, analyze earnings trends, examine dividend history, and evaluate debt levels to identify companies that are sound, profitable, and capable of weathering economic storms, while also considering qualitative factors such as management quality, competitive position, and industry stability, because a company's long-term prospects depend not only on numbers, but on strategic decision-making and corporate integrity. He emphasizes the importance of the margin of safety, ensuring that even if estimates or forecasts are slightly off, the investment remains protected because the intelligent investor always plans for uncertainty rather than relying on perfect foresight. Graham warns against overpaying for growth, explaining that stocks with dazzling recent performance may be overpriced relative to their actual value, and that buying simply because a company appears popular or trendy is speculation, not investment, which is why disciplined analysis is essential to distinguish true opportunities from market illusions. He illustrates his principles with examples of companies whose shares temporarily fell below intrinsic value due to market panic, highlighting how investors who remained rational, performed detailed analysis, and acted decisively captured extraordinary long-term returns, while those who followed emotion or hype often suffered permanent losses. Graham also outlines methods for evaluating bonds, preferred stocks, and common shares, stressing that understanding risk, yield, and security structure is critical for building a portfolio that balances safety and growth, and that diversification across industries and asset types mitigates unforeseen risks while providing steady returns. Beyond numbers, he teaches that successful stock selection depends on discipline, patience, and rational judgment, avoiding the allure of instant wealth or short-term trends, and reinforcing that knowledge, research, and careful evaluation are the investor's most valuable tools. The enterprising investor can find hidden gems by looking for companies temporarily mispriced due to market pessimism or overlooked by the crowd, while the defensive investor benefits from a focus on well-established leaders with predictable earnings and dividends, showing that both approaches require the same foundation of careful analysis, logical reasoning, and emotional control. Ultimately, Graham demonstrates that true security analysis is a blend of art and science, a combination of quantitative rigor and qualitative insight, and that by mastering these skills, an investor gains the confidence to buy wisely, avoid speculation disguised as investment, and steadily grow wealth over decades, proving that the intelligent investor succeeds not by chasing trends, but by understanding value, acting rationally, and exercising patience in a market that rewards discipline over emotion. Margin of safety and intelligent decision-making. Benjamin Graham introduces one of the most important concepts in investing, the margin of safety, a principle that serves as a shield against errors, market volatility, and the unknown, teaching that intelligent decision-making is not about predicting the future perfectly, but about protecting your capital while seeking reasonable returns, because even the most careful analysis can be wrong, and even the most stable markets can be unpredictable. The margin of safety is the gap between a stock's intrinsic value and its market price. Buying below intrinsic value ensures that even if circumstances change, the investment retains a buffer against losses. And Graham argues that this is the cornerstone of rational investing, separating intelligent investors from speculators who chase glamour stocks or hot tips without considering downside risk. He stresses that emotional discipline is crucial because the allure of high returns can tempt investors to ignore fundamentals, overpay, or act impulsively. But those who insist on a margin of safety gain both psychological confidence and tangible protection, which allows them to navigate market fluctuations with calm and rational judgment, avoiding panic selling during downturns or greed-driven buying at market peaks. Graham illustrates this with examples of companies that experience temporary setbacks or market mispricing, showing that investors who remained disciplined, calculated intrinsic value carefully, and respected the margin of safety not only preserved their capital, but achieved substantial gains when prices corrected. While those who ignored this principle suffered significant losses, emphasizing that intelligence in investing is not measured by clever timing or short-term performance, but by prudence, patience, and rational decision-making over decades. The concept extends beyond stocks to bonds and other securities, where evaluating risk, yield, and repayment certainty ensures that even conservative investments maintain a cushion against unforeseen events, reinforcing Graham's belief that protecting principal is as important as seeking returns. He warns against overconfidence, urging investors to recognize their limitations, question assumptions, and always allow room for error because the market will always surprise, and only a careful margin of safety can absorb shocks without derailing long-term plans. This principle also informs broader investment strategies, including asset allocation, diversification, and portfolio rebalancing, because each decision should prioritize protection first and opportunity second, blending caution with ambition. Graham concludes that the intelligent investor thrives not by gambling or speculating, but by consistently applying rational analysis, discipline, and margin of safety thinking, allowing them to make decisions that withstand uncertainty, capitalize on mispriced opportunities, and steadily grow wealth over time, demonstrating that investing success is less about predicting the market and more about controlling risk, making informed choices, and acting with calm logic, proving once and for all that patience, preparation, and rationality, anchored by a margin of safety, are the true hallmarks of intelligent investing. Investor psychology and timeless lessons. Benjamin Graham concludes the intelligent investor by focusing on the often overlooked but absolutely crucial factor in investing: psychology, the inner workings of the investor's mind, because the greatest risk in the market is not the fluctuation of prices, but the emotional impulses that drive people to make irrational decisions. And he teaches that understanding human behavior, both your own and that of the crowd, is the key to long-term success. Graham reminds us that fear and greed are constant companions in the market, causing panic selling during downturns and reckless buying during booms. Yet the intelligent investor learns to treat these emotions as signals rather than instructions, resisting the temptation to follow the herd and instead acting on reasoned analysis, patience, and discipline. Because the market's moods are temporary, but the consequences of emotional mistakes can last a lifetime. He introduces timeless lessons that every investor must internalize. First, accept that market volatility is normal and unavoidable, and rather than trying to predict it, use it as an opportunity to buy undervalued securities and sell overvalued ones, turning what terrifies the emotional speculator into a strategic advantage for the rational investor. Second, understand that wealth grows slowly through consistent, disciplined action rather than sudden, spectacular gains, and that attempting to get rich quick almost always leads to disappointment, reinforcing the importance of long-term thinking, patience, and a margin of safety in every decision. Third, focus on intrinsic value, not market price, and always ask whether the investment is fundamentally sound, because the crowd's opinions and the noise of financial news are poor guides compared to careful research and reasoned judgment. Graham also teaches that intellectual honesty, self-awareness, and humility are essential traits, because overconfidence, impulsiveness, and ignoring one's limitations lead to mistakes that compound over time. Whereas investors who understand their own psychological tendencies can structure their decisions to minimize emotional interference. He emphasizes that the principles of investing are simple in concept, but difficult in execution, precisely because human nature interferes, and that mastering one's own mind, controlling greed, fear, and impatience, is as important as understanding financial statements, dividends, or balance sheets, making psychology the silent partner in every successful investment. Throughout the book, Graham repeatedly reinforces that discipline, rationality, and a long-term perspective outweigh technical tricks or predictions, and that by adhering to proven principles, investors can exploit market fluctuations, identify value, and steadily build wealth, proving that consistent behavior guided by reason and emotional control produces results far superior to those achieved by chasing trends, speculating impulsively, or succumbing to the crowd. Finally, the timeless lesson of the intelligent investor is that intelligent investing is both a science and an art. It requires understanding the numbers, the business, and the market, but it also demands self-mastery, patience, and a commitment to principle over impulse, because over decades, those who control their minds, respect risk, and make decisions anchored in logic, research, and margin of safety thinking will not only protect their capital but also achieve lasting financial success, showing that the most powerful tool in investing is not information or insight alone, but the disciplined, rational, and patient mind of the investor itself, which when trained and applied consistently, can turn market chaos into opportunity, uncertainty into security, and effort into enduring wealth.